Okay, I think we can get started then. Assalamu alaikum and good morning to all our attendees and viewers, whether you're with us live during the session or catching a recorded version of this. Thank you for joining us today to take you through what's behind our 27-4 Shari'ah Active Equity Prescient Fund. For those that don't know me, my name is Ridwan Kaji. I'm an investment associate at 27-4 Investment Management with a specific focus on private markets, and I'll be introducing and moderating our session for today. Presenting our session today is my esteemed colleague, Dr. Daniel Page, who is the head of quantitative analysis at 27-4 Investment Managers. Dr. Dan is a senior lecturer at Prescient University, where he obtained his PhD in finance. With more than a decade of experience and having self-learned the art of coding to enhance our investment process at 27-4, Dr. Dan is our in-house expert in all things modeling, and he's harnessed the power of machine learning to do things like optimizing strategic asset allocations, time series forecasting, and determining currency and interest rate cycles. The intention behind hosting this session today is to provide a bit of insight into the genesis and methodology behind the 27-4 Shari'ah Active Equity Prescient Fund performance, and why we believe the fund is positioned to continue delivering market-leading returns. The logistics of today's session. Dr. Dan's presentation will run for around 30 minutes. Thereafter, we'll allow time for Q&A, and we encourage all our participants to please participate and pose any questions that you may have through our Q&A or chat functions. Now, before handing over to Dr. Dan, I'm going to get started by giving a quick synopsis around the context behind Shari'ah investing and touch on the governance processes specifically in regards to our Shari'ah funds. So really, starting at defining Shari'ah, Shari'ah literally means, or is literally translated as the way or path to water in some interpretations. It's a term that describes Islamic law and forms the foundations of Islamic finance and Sharia investing. The four recognized sources, as you'll see I've got on the slide, of Sharia law are the Quran, the Sunnah, or authentic traditions of Prophet Muhammad, peace be upon him, consensus of opinion of Muslim jurists, and judgment from deductive juristic analogy. Now, Islamic finance in particular is a financial system governed by Sharia law, based on being beneficial to society and humanity by avoiding potentially harmful and exploitative practices and behaviors. It seeks to do this through some very fundamental principles, which you'll see I've got on the right-hand side of the slide. Promoting equality and social justice is one. Two, prohibiting interest in all transactions, with some tolerance for interest-bearing debt used in companies which are invested in. I'll get into that in a minute. What this does preclude from Sharia investing are things like conventional bonds, money market investments, and investment in conventional banking and insurance companies. There are Sharia-compliant fixed income and money market products, which do form part of our portfolio, but more on that a bit later on. Number three, transactions being free from speculation or unreasonable certainty. Activities that generally fall under this category are things like gambling. So casinos is one example of what would not be a permissible investment under Sharia law. Derivatives trading businesses would also fall under the ambit of this preclusion in particular. Number four, businesses which operate on the basis of halal or permissible activities. Now, in this category, the better way to potentially interpret this is to assess activities which are impermissible. I've already mentioned interest and speculative businesses. Some other businesses that are part of the alcohol supply chain, pork or non-halal slaughtered meat products, tobacco, weapons or arms traders are other categories that effectively are considered impermissible. And I guess the final point around the principles is really profit and loss or risk and reward sharing between partners. Now, as a very brief opening, in closing this slide, the final comment I probably want to make is that the complementary principles behind Sharia and ESG investing are wide and well documented. Both of these investors, whether Sharia or ESG, avoid certain activities and products so their portfolio align with the values of beneficiaries and clients, align with the goal of developing a sustainable and fair society, and do no harm to people or damage to the environment. Hence, Sharia portfolios are quite a nice mechanism for ESG investing as well. So in assessing whether an equity investment meets the criteria for being Sharia compliant, there's essentially a three-step process which is undertaken. The first is core business screening. It's effectively an assessment of a company's core business activities to ensure these are not in contravention of Sharia law. Again, this is where your listed banks and tobacco companies, for example, would be removed from the Sharia equity investable universe. The next type of screening is termed financial ratio screening and is where the interest tolerance I touched on earlier comes into play. Islamic scholars have considered it acceptable to invest in companies which have some degree of exposure to interest, either through interest-bearing debt or an insignificant amount of interest income, for example. However, there are thresholds up to which interest-bearing debt and assets are acceptable, which is the basis for the screening test. The third step that you'll see on screen is verification of dividends or returns. What this does is that where non-permissible income, so effectively interest income from a term deposit account, for example, is less than 5% of a company's total income, that non-permissible income is considered to be embedded in the dividend that is paid and is effectively stripped out. So to bring all this together, and the last bit from me really is that the elements of comfort that can be taken around our compliance with the tenets of Sharia in our fund offering is really threefold. Our in-house capabilities, the use of external Sharia consultants to perform the screening processes I described earlier, and the presence of an independent Sharia board who closes off our governance processes and with whom we regularly engage and seek sign-off from on our processes and asset selection. And I guess with that, I'll hand over to Dr. Dan to take you through the next bit and really the crux of our presentation. Dr. Dan.
Thank you very much, everyone. So let me just, I'm actually going to share my screen. Can we see my screen? Okay, so effectively what I'm going to be taking you through is the genesis of the 2074 Sharia Active Equity Fund, as well as the new applied methodology, how we arrived at it, and what are the potential benefits and how it fits into our stable. So first focusing on genesis and fund methodology. The fund was initially managed by Visio Capital, and Visio Capital has a particular style when it comes to management that worked incredibly well over the period 2012 to 2016, when they initially managed this fund. And their style was looking at small and mid-cap off benchmark bets. So literally looking at where there's true value in the market. And they would hold at maximum between 50 and 20 shares. So it'd be a very concentrated view on a number of very well-researched bets. Problematic with that, and we're going to describe that, is that the fund actually started, so unbelievable performance from 2012 to 2016, but from 2016 onwards, it had a bit of a negative run. And that can be chalked up to the fact that there was a strong resource rebound. So the JSE at that time, and even now, is made up with the top level, the large market cap portion, or the larger shares in the JSE. A lot of resources sit there. So they didn't take a lot of resources bets, and resources rebounded strongly. Another thing is that Rand hedge shares actually started beating Rand tracker shares or SA Inc. shares. So we had this unbelievable rise of Naspers and the likes of the other miners who are all considered Rand hedge shares. And the more locally based shares, and when I say locally based, all these companies are listed in the JSE, but I mean the actual business interests are housed in South Africa, they took quite a knock. Another thing that's an important point is that the actual benchmark that's used for most Sharia equity investments in South Africa is largely uninvestable, and we'll go into that also. So what was presented to us at 2074 was a gap. We needed a change, and it also meant we could actually easily articulate an objective and an aim of a fund that meets all the necessary criteria of being an optimally diversified, decent Sharia equity fund that focuses on the SA space. So we needed a higher level of benchmark compared cognizance. So taking significant off-benchmark bets, specifically, so just giving a little bit of insight into the benchmark. The benchmark, either the Shari'ah top 40 or the Shari'ah cap top 40, that's the top 40 shares on the JSE, but it's the current top 40, but only looking at the shares within the top 40 that are actually Shari'ah compliant, which meant that you had a huge resources exposure. So what we needed to do was ensure that a new portfolio, a new methodology is more benchmark or peer cognizant. So we couldn't differ too much from our peers, and it couldn't differ too much from the benchmark. It had to also deal with the fact that there was way too much resources associated with that benchmark and peer cognizance. So it needed to be diversified. And the last thing is it had to be simple to explain and implement. Those are the key criteria of any of our investments, is that, yes, there can be a lot of mathematics that goes behind it, but the essential crux of every investment has to be easily understandable and explainable. If it isn't, it doesn't pass our investment team or our investment committee team. So in 2019, what 274 basically did was we started bolstering our passive and smart beta offering. That was effectively when I joined, and my background is much more in the quant side and passive and smart beta type strategies. And what we were tasked with was investigating solutions for the Shari'ah active equity portfolio that meet all of the requirements or objectives above. So what we specialize in as a quant team now is systematic passive and smart beta strategies. It's not all we do. We do a lot of asset and liability modeling. We do all the strategic asset allocation modeling. We do any form of derivative modeling or interest rate modeling and forecasting. But one of our core competencies is passive and smart beta strategies. So we were tasked with trying to come up with something that met all of these criteria. So let's actually go into passive and smart beta, where we can discuss what are the basics of passive and smart beta and how we actually applied it to a Shari'ah portfolio. First things first, just talking about passive. Why passive? What passive implies is buying or replicating a benchmark. So literally, there is no thought behind running a passive strategy. That is why it's innately cheaper, because what you're doing is you effectively have a published benchmark and you just buy or replicate that benchmark by buying the equivalent weights in each one of the underlying assets that form that benchmark. So what are the benefits? You have a clear benchmark risk minimization. It's cheap to implement. You don't spend any money on analysts determining what type of shares are cheaper or better. It literally is just based on the index itself. It's rules-based, i.e. you know when it rebalances, what shares come in and what shares come out. And when I say you're exposed to beta risk only, it means that you are only exposed to market risk. There is a downside, and let's talk about that. The margin, you always are going to marginally underperform the benchmark after fees, because a benchmark naturally, when you have, say, the cap 6 or the J203 or the top 40 on the JSE, if you want to replicate that, you are actually going to buy and sell shares. That means that there are fees involved. Additionally, there are fees associated with management fees because you're actually managing the product. So you're always going to marginally underperform a benchmark after fees. Another cost is that there's limited alpha or upside because you are only taking on beta risk. That means if you're purely replicating an index, you only have beta risk. There is no opportunity for upside. And the last thing is there is a execution risk, because whenever there's trading and whenever there's rebalancing, there is potential for a finger error. Someone makes a mistake and you end up not tracking the benchmark. And there's no opportunity to try and make up that difference, because you can't actively buy positions to try mitigate that difference. So when there's a risk event and you miss the mark on something, it costs you, and it costs you for a long time. So a benefit that isn't commonly addressed is that most active managers, so why passive again, and focusing on the benefits, is a simple benefit is that literature, so both literature and people note, is that most active managers fail to beat their benchmarks. What that means is that you get a lot of active managers that spend a huge amount of money on hiring very smart people to pick shares, But what we find is that a lot of those managers don't actually beat their benchmarks consistently through time. So we did a little bit of analysis just to prove that true. The question is that true in SA? And that takes us to the next slide. So what we've done here is looking at rolling windows, right? Rolling 60-month windows of all managers listed under the general equity, well, a CISA general equity category in South Africa. So anyone that's available, you go onto Morningstar, you can get all the managers through time that have returns available over this period that we did it. So here you could see that the first period is 2007 to 2011, and you can see it's rolling windows with a 1-year gap, 2008 to 2012. Now, how to actually read this figure is that the red bar describes the number of active managers that actually outperform the benchmark. The gray bar is those that underperform the benchmark. And what you could see is, over the first rolling period, only 20% outperformed. Over this period, less than 20%, still less than 20%. From 2015 to 19, it did jump a bit. So you have around 40% of managers outperforming the benchmark. And it nearly went above 53% in the last 5-year window from 2016 to 2020. It was the best year for managers because it indicates that only 53% of active managers outperformed the benchmark. That means that 47%, you can literally take all the active managers in South Africa over the last 5 years, cut them in half of them outperformed the benchmark, half of them underperformed the benchmark, which means that there is probably room for why passive would work, because all of these, most active managers charge fees that are higher than passive. It may be beneficial to just buy a passive benchmark. Then the question is, why smart beta? So what is smart beta? Smart beta is it's almost like a hybrid methodology, and that's exactly what the figures on this page describe. It's a hybrid methodology because what you're doing is you're looking at a passive benchmark. You buy the entire benchmark as it is. So imagine each one of these beads is the entire benchmark and you just buy all of it. That's a pure passive. Active means picking particular shares. We know that. What smart beta is, it is using some form of systematic rule to pick shares, right? And use a systematic rule that's ones and zeros. So that implies some form of rules-based programmatic type structure. And that will result in a portfolio that blends both active and passive. So what you're trying to get is you're going to get the benefits of passive in the sense that it's systematic, rules-based, and theoretically cheaper. But you should be able to get a bit more alpha upside, right, from picking particular shares. So how did we actually apply this to Shari'ah investing and passive? So let me provide you a framework. Shari'ah investing in the equity space presents a number of additional dimensions. So you have a limitation of the investable universe based on Shari'ah compliance. As one clearly stated, you are excluding a large number of shares on the JSE due to them not being Shari'ah compliant. So the likes of the banks, so the typical ones would be the banks, any breweries obviously are out. Funny enough, NASPAs and Prosus are not Shari'ah compliant, so you can't invest in them. And they are obviously, NASPAs is the biggest share on the JSE. A number of food retailers you can't invest in due to the fact that a portion of their sales is due to alcohol and tobacco. Problematic. So what one needs to do is you have a limited universe that you can invest in. Then there's a benchmark issue. The benchmark issue is that in South Africa, the benchmark is the JSE Shari'ah Top 40 or the JSE Shari'ah Cap Top 40. Most people opt for the Cap Top 40. And what that does, the problem with that is that it only considers shares within the top 40 that are Shari'ah compliant. So you don't actually have 40 shares in your Shari'ah Top 40. You have around 16 shares, which means that you have a very undiversified portfolio that is incredibly resource heavy. That makes that benchmark a little bit uninvestable, and it has sector risk and firm-specific risk in it. So now, articulating the goals of 27.4 and why we envisioned the strategy, we did a huge amount of backtesting and arrived on a methodology that we believe works best. What underpinned that was the goals of 27.4 and specifically the quantitative strategy team. We wanted to develop a Sharia compliant equity portfolio that is well diversified and liquid. So we wanted to mitigate the impact of only looking at the top players. And we also wanted to be liquid. So the problem is that if you look at shares that are not in the top 40, i.e. you go to the top 60 or top 80 or top 100, you're dealing with shares that are potentially illiquid, and it means you can't get in and out of them quickly. So our focus was diversification and liquid. Our focus of this portfolio, because obviously, as Ridwan clearly stated, a big aspect of Sharia investing is that you want to try mitigate the risks associated with this. Risk mitigation is a big aspect. So there's trying to remove an element of the gambling aspect. So, and not to say that investing in shares is a gamble, but it obviously it is gambling in some sense because it's higher risk than other asset classes. So what we want to do is create a strategy that allowed for a well-diversified liquid portfolio, but the core fundamental aspect was that it needs to be a risk mitigant because it obviously is also a building block in our other Sharia balanced offering products. And lastly, not only that it's a building block portfolio, it has to be able to stand on itself and do well through time and at least be consistent. That's what we want. You don't want massive swings in this portfolio. So using that or underpinning that, that's how we came up with the methodology that we're going to describe. And that's part 4. So we apply a strategy called equal risk contribution. So equal risk contribution is not a methodology for picking shares. It's rather a strategy for trying to weight shares in such a way that you get the best benefit in terms of diversification. So just apologies, this may be a bit esoteric, but it is important to understand because this is what underpins, it's the secret sauce that informs the strategy. So any portfolio, right, in any portfolio, we know that different shares contribute differently to the overall level of return. So if you have a portfolio, theoretically, a portfolio will have shares that contribute high to return, some shares that don't contribute much to return, and some shares that detract from return, right? And that is based on the return of the shares as well as their weighting. So obviously, if you weight more to shares that have higher return in a particular period, your portfolio will outperform. If your weighting is to shares that have underperformed in a particular period, your portfolio will underperform. What's important to note is that the same actually applies to portfolio risk. So what you can do is you know that if you weight more to high risk shares in a portfolio, your portfolio overall will be more risky. Similarly, if you weight less to high risk shares and upweight or overweight low risk shares, that will practically reduce the volatility of your portfolio. So what that means is that you have an additional lever to actually control the risk or volatility of your portfolio using weighting. And that's what equal risk is about. So how does it actually come together? So you can identify quite easily, and it's very easy maths, because all you need to do is just look at how have a set of shares done historically, because you can see what is the return. You can also see what their risk is. And if you assume that you hold all of these guys in a portfolio, you can actually calculate what is their contribution to risk. So if we know the historical contribution to risk, which is easy to determine, you can solve for weights that equalizes their risk contribution. All that means is that I can look at a set of shares, and what we do is now, as Ridwan stated, we don't identify the shares ourselves. What we do is we rely on an external third-party consultant to tell us and do consistent screening of the full JSE and say which shares are Sharia compliant or non-compliant. And what we'd do is we'd look at those shares through time. We'd look at the top 40 shares in any particular period when we typically rebalance. We rebalance quarterly, just to give that insight. And we'd say, okay, looking at these top 40 shares, what is the risk profile of those top 40 shares if you were to hold them in a portfolio of equal weights? And then what you do is you solve the weights that would give them each an equal risk contribution. And what that means is that you are going to downweight shares with high risk contribution, and you're going to upweight shares with low risk contributions. And that is effectively what ERC means. So what we landed up with, I'll just give a bit of a genesis around this, was the research was initiated in December 2019 to consider a framework of developing an effective Shari'ah equity strategy appropriate for the JSE. It took quite a bit of time because obviously every time we presented something, there were potential drawbacks and we had to consider other machinations. So a lot of idiosyncrasies kept in, but what we landed on was the optimal portfolio in backtest seemed to be a portfolio that considered the top 40 Shari'ah compliant shares listed on the JSE. Now, what one could do is you literally could take those top 40 shares and just invest based on their market cap weights. Then you'd have a market cap weighted index like most of the JSE indices, or you could have used a shareholder weighted weighting schematic like you have in the cap SWIX or the full SWIX. But the problem with that is it's still giving too much weight to the larger shares. And what that would naturally have done is that the top 40 shares that are Shari'ah compliant, you still would have been completely overweight resources. So what we did was we said, let's use a smart beta weighting methodology, which is equal risk contribution. So what we do is, as I said, Shari'ah compliance research outsourced to an independent third party. And the role is that every single month, we get a list of shares and how they've changed in terms of their Shari'ah compliance. And that is, so we get those shares and we obviously monitor that. And we wait till the next quarter. So if a share is non-compliant, so it's quarterly rebalancing exactly like all the FTSE indices listed on the JSE or provided by the JSE. We still use quarterly. But what we do is we would always look at the top 40 shares before and after the determination of the Shari'ah compliance. So if a share becomes non-compliant in between a period, we don't sell out of it immediately because you have 3 months to do so. And we're actually extra careful because some share, the way that it works is that a share can show signs of becoming non-compliant, i.e. it has a, it almost gets like a yellow card, a purple card, then a red card. So when a share gets a yellow card, the problem with that is that you can't upweight or downweight that share, and that would violate our methodology. So if a share goes yellow as opposed to being green, green means it's fully compliant. When it goes yellow, we actually start selling out of that share, but only at the rebalance date. Because what we're trying to do is utilize the benefits of passive in that we don't trade too much. Also, something that's important is that we utilize 80 to 85% of the total offshore equity allowance. And that's something that's applied across the board, across all Shari'ah equity funds in South Africa. So you are allowed a total of a 30% offshore allowance. And what we do is we also apply an ERC on global Shari'ah compliant shares. So, but that only relates to around 25% of the portfolio, 75% is locally based. And as I said, it's rebalanced quarterly. We don't use the exact rebalance date that's used by the FTSE, which is the Friday after futures closeout. We don't use that. We normally do it the week after. So this month is a rebalance month. Now, the question is, has it worked? So just a very simple analysis. We do go through the details of how the fund has performed. We do give some fund metrics so far, but I just thought we'd do this analysis and just show you just the impact of the change. So what's happened here? You can see that we have 2015, 16, 17, 18, 19, and 20. 2016, and so unfortunately I don't have the data from 2012 when this fund started being managed, but in 2015, you could see that the manager of this portfolio at the time had an incredibly good year. And that's when the small mid-cap bet paid off. Unfortunately, from 2016, you can see that there was just this underperformance through time. Underperformance. However, in 2020, this is where the year that we've actually implemented the strategy. So we implemented it in March 2020. And thus far, thank God, the performance is consistent with the back test that we conducted, and it's been very positive. Now, we can actually look at the fund stats and performance of this fund. So just more formally, what does the fund look like today? So what you can see here is that approximately 74% of the fund is invested locally, 24% is offshore equity. We hold around 1.8% cash. So it normally is between, total cash holding should be between 1.5 and 2% because it is a unit trust. We try to maintain a cash balance around there. If you look here, this is what the current sector allocation looks like, as well as cash. But you could see here that basic materials still makes up the bulk of this portfolio, right? 32%. However, you will note that other funds in this arena can have resource weightings in excess of 50 to 60%. And if you look at the actual benchmark, which is the Shari'ah top 40, and the cap top 40, that's currently sitting on a resources weighting around 65 to 85% through time. So it significantly mitigates the impact of being too resource heavy. You can see that there obviously is a lot of healthcare in there. And this healthcare is mainly associated with our offshore component. So this is the offshore and local component because the offshore component, the biggest shares that we own on the offshore side would be Johnson & Johnson. That's our top holding. If you actually want to see the top holdings, we do the top local and offshore holdings. So you could see here that our top local holdings is Montauk Renewables, Italtal, Bytes Technology, Cartrack. So that's obviously consumer goods, the rest of these guys. So it is an energy stock. Bytes and Cartrack are both tech stocks. AECI, Tiger Brands, Vodacom. So you'd see in our top 10 holdings, we don't actually have any resource tickers. Yet, because it's the top 40 shares, in the bottom 30 shares, that's where most of the resources you'll find them at different weights. If you look at our offshore holdings, the top 10 offshore holdings, you'll see a number of consumer goods. You'll see a couple of energy shares. You'll mainly see health and pharmaceuticals, so Johnson & Johnson, Roche, Abbott Laboratories, and we also have the likes of a number of tech stocks that are Shari'ah compliant. The likes of the FANGs, most of them aren't Shari'ah compliant, so your Facebook, Amazon, Google, and the like. But Intel, Adobe, and Salesforce, they are all Shari'ah compliant. Just to show you fund performance through time, thus far, so over the since inception, and thank God for the last year that we've had, you could see that we've done incredibly well against our strategic benchmark. There have been periods of underperformance. So year to date, we've underperformed by about 26 bips. We're actually making that up as we speak for this month in March. But over the 1 year, the 3 months, we're in excess. The 6 months, we're slightly below. And 1 month, this is at the 28th of February, 2021, we were below the benchmark, but we're making that up in March. If you look at the cumulative performance against the benchmark, you can see that there's solid outperformance on a cumulative basis through time. And lastly, if we were to look at scatters, so we here have the 3 month scatter, the 1 year scatter, and the 3 year scatter, which shows return relative to risk. We don't want to specifically, so there are around 6 now Shari'ah equity funds in the market. There were 7, but they're now 6. As you can see here, that we have done relatively well. We've mainly come in at number 2 through time. And that's due to the uptick in performance. Hopefully soon, please God, you'll see us take over the number 1 spot. And that is effectively everything I have to say. I think we can go back to Ridwan. I'm going to stop sharing my screen.
Great. Thanks for that, Dr. Dan. Any final words from your end?
No, I just very, very thank you so much for listening, taking the time, and please God, this fund grows from strength to strength, and it keeps on working. And we hope to be top of the pop soon, and God willing, it will be.
Great. Thanks, Dr. Dan. Thanks to all our attendees for joining this session. The recording of this will be posted on our social media, so please do look out for that if you'd like to catch anything. Again, if there's any follow-up questions that you have, please post it or get in touch with myself, which is ridwan@274.com or daniel@274.com, or visit our website for any other contact or any other information that you may need. Once again, appreciate all your time in joining this, and please do stay safe and keep well, and we look forward to presenting again to you soon.